InFi, episode 32.
Welcome to InFi, the future of finance, hosted by American economist and author Dr. Robert Murphy. Each week, tune in for dynamic discussions with business pioneers about emerging trends in finance, life insurance, asset management, technology, and more. Now, let's talk the future of finance.
Hey, everybody, welcome back to the InFi podcast. Today I'm going to be speaking with Economist George Selgin, who is an expert in monetary and banking theory. Interestingly, you may know that George and I had a debate at the Soho Forum in New York City a few years back. I won't tell you what the results of that debate were, but that's what George and I allude to at one point in this discussion. And so I'll put a link to that if you want to go see that. But in this episode, we're friends. He has written a new monograph for the Cato Institute on a very important topic, namely discussing whether banks are intermediaries in the credit markets. So just to let you know, folks, I'm going to write up a post at the Infinio website that kind of unpacks a lot of this stuff. So right now I'm going to be extremely brief just to set the table. But again, if you want to read more besides just the link to George's paper itself, but if you want to kind of see me summarize the big picture, my own take on his debate with some of his critics that he brings up in the paper, it'll be linked at this podcast. You know, if you go to InFi episode 32, you'll see a link to my article as well as to George's longer piece. But also, if you just stumble at the Infinio archives, it's going to post during the week of April 15th, 2024 is where to look. So anyway, very quickly, what are we talking about in this episode? The old school view of economists was, hey, what are the functions of banks? So one thing is that banks are a place to keep your money safely, right? If you want to have a checking account, and it's very convenient to store it at the bank. It's harder to rob a bank than it is to break into somebody's house. And, they can provide check cashing services and things like that. But also they act as, so the old theory went, credit intermediaries, where households in the economy would save, they would live below their means, they would consume less than their income, and then those savings would have to get channeled to the borrowers in society. And so banks aren't the only institutions that act as credit intermediaries. There's, other types of institutions in the financial markets that do that, but banks would be one of the channels that would transmit the savings to the borrowers, right? So people put their money into their bank accounts, and then the bank lends out some of that to people who take out a mortgage. That's the idea. So against that backdrop, some more recent economists have begun challenging that view, saying, no, actually, especially since central banks around the world went off the gold standard, and now commercial banks can engage in fractional reserve banking, there's a sense in which they can make loans that create money, quote, out of thin air. And there's a sense in which, and they're not making this up, it's a defensible position. There's a sense in which a bank doesn't need to sit there and wait for a deposit to come in so they've got money in the vault that they can lend that out to a borrower. That no, they can go ahead and make the loan. And in terms of the accounting, the bank's assets and liabilities go up simultaneously when they grant that new loan to somebody. And that's just not how other businesses do their accounting. So there's something special about the treatment of modern commercial banks such that maybe it's not the case that we should keep calling banks as credit intermediaries. Okay, so that's the dispute. And like I said, here in this episode, I'm just going to mostly facilitate George getting his opinion or his perspective across to you, the listener. That's my role here. If you want to see me kind of referee the debate, because I think both sides are making valid points. And then the issue is just, well, how do we balance their different perspectives? Like I said, I'll point to the article that I will have up at the Infinio website and will be linked in the show notes for this, which is episode 32. So let me now just quickly round this out by reading from George's official bio. George Selgin is Senior Fellow and Director Emeritus of the Cato Institute's Center for Monetary and Financial Alternatives and Professor Emeritus of Economics at the University of Georgia. His research covers a broad range of topics within the field of monetary economics, including monetary history, macroeconomic theory, and the history of monetary thought. His many writings include The Theory of Free Banking, Money Supply Under Competitive Note Issue, which was in 1988, Less Than Zero, The Case for a Falling Price Level in a Growing Economy, which is 97, Good Money, Birmingham Button Makers, The Royal Mint, and the Beginnings of Modern Coinage, 1775 to 1821. That's the period the book covers. It didn't come out at that time. And Money, Free and Unfree, which came out in 2017. His current book in progress, False Dawn, The New Deal and the Promise of Recovery, 1933 to 1946, will be published by the University of Chicago Press in 2024. Selgin lives in Granada, Spain, where he moved in 2022. So, without further ado, here is my discussion to talk about his new paper, arguing that banks are usefully thought of as credit intermediaries, George Selgin. George, welcome to the InFi podcast.
Oh, thanks, Bob. It's great to be here.
So we've got a deep but important topic today. I saw that you had been grappling with this claim that many economists and other sort of policy wonks are making lately to say that banks are not intermediaries, and they poo-poo. They're like, oh yeah, there's a lot of these hard money types that are worried about QE and such, and they're having a throwback to this old notion that banks are intermediaries between savers and borrowers. And we all know that that's not the case. And look at all these publications, particularly coming out of the Bank of England, that have just, put the nail in the coffin of that. And these dinosaurs can't move on. And you valiantly, heroically, perhaps in a quixotic fashion, have a working paper out for the Cato Institute titled Banks Are Intermediaries of Loanable Funds. So with that, I'll just give you the floor for a bit. Before we dive into the super details here, can you just kind of give more of the framing of this in the context so the viewer knows what we're talking about?
Yeah, sure. Well, I think for your audience, Bob, it's fair to say that most people appreciate the fact that fiat money issuing central banks can create all the funding they need to make all the loans they need or buy all the assets that they need. And they don't have to, as it were, go around hat in hand and borrow from anybody in order to be able to accumulate assets to make their balance sheets grow. And as you mentioned, QE certainly represents for all of us very starkly the capacity of central banks to acquire assets using nothing but their printing presses, as it were. Now, the theory I'm going after, quixotically, as you say, appropriately enough now that I'm in Spain, that theory holds that ordinary banks, that is every commercial bank, that the kinds of banks that you and I deal with, have the same capacity. That is, they essentially can create their own funding out of thin air. And that's all they need to do is to use their money-creating powers to engage in as much lending as they like. So every bank is put on the same footing by this theory as most people would agree central banks are on. And I think that's the argument that there's no difference is completely false. And my paper aims to show why what central banks can do isn't something ordinary banks can do. They really do have to borrow from other people, borrow real savings from other people, for the most part, in order to be able to acquire assets and make loans. They can't just write their way into all of the assets that they would like to acquire.
Okay, and so why don't we, before we start getting into the particulars, so I think the listener now understands the big picture, at least of what we're talking about, but then they might say, why do I want to spend an hour listening to this? So can you give them a quick commercial? Why should they care?
Yes, well, the reason your listeners should care is we often see occasions when too much money creation goes on and inflation results. And it's important to understand where the problem lies. Where does responsibility for this kind of thing belong? If, in fact, every commercial bank has the same money creation powers, or I should say lending powers, as a central bank does, in our case, in the United States case, I should say, if every bank is just as capable of contributing to arbitrarily to asset acquisition and expansion of credit as the central bank is, then, of course, in any inflationary process, they should be as suspect as the Fed. Whereas if I'm correct, the Fed is suspect number one. Its powers of excess credit creation are far vaster than those of ordinary banks. And indeed, most of the time when ordinary banks are engaging in too much credit creation, and they do engage in too much credit creation sometimes, it's only because they're being enabled to do so by the reserve creating activities of their central bank, which is really the ultimate cause of trouble. So that's I think the most obvious policy implication that comes from taking my point of view, as opposed to the other point of view that said, look, even if your central bank is doing everything it can to not have credit grow excessively, the commercial banks, those bad commercial banks, can do it all by themselves. So it's really a problem that the central bank isn't responsible for and may not even be able to prevent. That's what comes from the other theory.
Okay, let me just push on that one more. So, because that was partly when I read, your paper very carefully, and then I at least skimmed the Jakov and Kumov. Is that how we're pronouncing their names?
That's how I pronounce them, yeah.
So I'll follow your lead. I think, you listed in your paper, like, here's some representatives of what you were calling the thin air theory, just to contrast with your approach. And yeah, I agree that I can understand why their paper is lauded by that camp as, hey, look how rigorous this is. They got a nice internally consistent mathematical model with all the superscripts and subscripts and so it's very impressive.
Empirical tests.
Yeah, right. Yeah. So they do everything you'd want in terms of a modern scientific economics paper where they have a model, they solve the equilibrium, and then they run through here's some shocks, and they do different shocks, and then they look against the actual data, the stylized facts of how modern economies work, and it looks like their approach, their model better matches the data than the rival model. And I want to go ahead and just say
That's
right
what
now.
They claim.
So they're in their framework, they're contrasting what they call the ILF approach, which stands for intermediary or intermediation of loanable funds. And so that's like the old school people, they think, where banks are basically like just, savers are hoarding cans of tuna fish and kerosene. They give it to this thing called a bank, and then it lends it out to businesses. And that's what they and I'm exaggerating a little bit, folks, but I'm not full. Like, they really do.
Not that much.
And their papers say the people we're attacking implicitly are relying on banks as physical warehouses. And then they're contrasting with what they call the FMC approach, which is financing through money creation. Okay. And again, just to finish the train of thought, they solve for the two types of models. And they say, look, in our model, there's bigger swings in bank balance sheets, due to particular shocks. And that's what we actually see in the real world, that in terms of like savers' preferences being tweaked with consumption smoothing over time. The old school model, the ILF model, where banks are just pure intermediaries between actual household saving and business borrowers, you wouldn't see these wild swings the way you do in the real world in a typical business cycle. So that's why they think their model's more rigorous and empirical. So anyway, just to circle back, what I was getting at, George, I didn't see in their particular paper, it looked like they were just laying out the framework, and then in the conclusion, it was sort of like, we think this is a more fruitful approach that better matches the data, and we leave it to others to go do something with this. Like, they didn't actually say the ILF people have this policy conclusion, whereas we have this.
That's right.
So you're saying that, but no, you have seen some people, or they might even say, if you're worried about inflation, trying to get Powell to raise rates, that's stupid. What are you even looking? That's not even where it's coming from. Is that kind of the rhetorical move they make?
Well, so two things. First of all, plenty of people who subscribe to this view that banks aren't intermediaries, that they can create all the funding they need with a keystroke, that they do, many of them do essentially claim that the banks have the same powers. They are claiming that the banks have the same powers of money creation as a central bank, and some of them go further and explicitly say the central bank doesn't have much ability to control how much money creation and credit granting goes on. Now, in the Kumhoff and Jacob paper, I should say Jacob and Kumhoff, Jacob's the principal first author, they don't state that policy conclusion, but it's absolutely implied by their arguments. Absolutely implied. There's no way around it. If their theory is correct, there is nothing except some regulatory barriers to limit credit expansion. So, yeah, you can limit credit expansion by the private banks if you impose all kinds of restrictions on them. They can be capital restrictions, they can be legal reserve requirements. But merely restricting the availability of reserves, which is the stuff the central banks create, that doesn't do it. Because essentially, their story says that the banks don't have to have any reserves unless they're forced to in order to engage in all the funding, all the lending that they want to. So if I'm attributing or drawing policy conclusions, which I claim are the conclusions of this theory, what I mean is either the proponents of the theory say so explicitly, as some do, or it's simply implied by their arguments, as in some other cases. But it's there. It's very much there. And this is important because we've moved to a world where now in the United States, as well as elsewhere, there are no statutory reserve requirements. So if those are necessary to tie down the ordinary banks and their money-creating activities, then we're that much closer to being in a world where those activities aren't really tied down much at all. As I insist, all of this is quite false. By the way, I think it's obviously false to many people. The problem is that we have a theory here that says otherwise. I should say I've had two responses to my pushing back against this view that banks aren't intermediaries, and they're diametrically opposed, so I mention them. One says, this is just a semantic quibble. Those people aren't really saying anything different than you are, so you're wasting your time. The other group says, I must be making up this other theory because surely nobody would say anything like that.
Yeah, right.
And these are irreconcilable. The only thing they all agree on is that I'm wasting my time. But in fact, though...
Well, I suppose, George, theoretically, you could reconcile those if the person said, no, you guys are saying the same thing and you're both nuts.
Yeah, but I think that, I don't think we're saying the same thing. I think we're saying some substantively different things. This is a real debate about what real resources ordinary banks required in order to engage in the granting of credit, and whether those requirements are substantially different from what a central bank with fiat money creating powers faces. So that's the substantive debate here. And even if you don't think the policy implications are that important, let's say you believe that we have enough restrictions on commercial banks that even though they don't need reserves to make loans, we can force them to restrict their lending in other ways besides reserve scarcity. It's still very important to understand correctly just what it takes for banks to make loans or not be able to make loans for all kinds of reasons, and why that is, how that their powers do or do not differ from those of central banks.
Okay, so I struggled, George, when I was thinking through how we're going to go through this interview. Like, obviously, if you and I were just truly talking to each other on this, we would have one conversation, but that might not be particularly illuminating to outsiders. So why don't I motivate it this way? A lot of where they're coming from is to say, look, it is simply not the case that a bank needs to have, it has to sit around and they want to make a loan, but darn it, they can't. They got to wait for some other depositors to first come in, put the money in the vault, and then they get it. And they said, that's not true. The very act that the bank's assets and liabilities move up simultaneously. Checkmate, Selgin.
Yeah.
So you want to respond?
Okay, so the truth is there's a grain of truth to that criticism, but only a grain. And what you just described, the two alternatives you just described, that's what Kumhoff and Jacob, or Jacob and Kumhoff, that's what they compare in their model, right? The view where the bank can only lend more if he has to wait for people to bring their savings to it in the ordinary course of business. And then if it gets enough, it can lend more. Of course, that makes banks very passive in the lending process. And the other view is, no, they just write up all the loans they like because they don't really need to get any savings from anyone. Actually, neither of those views is correct. It's true that banks have to borrow in order to lend, but they don't have to wait to do that. Let me explain. A bank, first of all, a bank to make a loan, initially, all it has to do is say to the borrower, okay, we're going to credit your account by X. Let's say $1,000. Now, up to this point, yeah, you've created money and a loan, and you don't need anything as far as making that book entry is concerned. That's true. But hold on. When the borrower goes out and uses the funds, which is what borrowers do, they don't borrow money to leave the stuff at the bank. You're paying interest for what? To make the bank's balance sheet bigger? No. You're getting this loan so you can buy a house, or a businessman can buy some equipment or pay workers in advance of production and sales and so on. So the money gets spent. In a world with a lot of banks, it ends up getting deposited in all probability at some other bank. That bank sends the check or whatever the items are. Nowadays, it's mostly electronic transfers, but they get a message and this entitles them to make a claim on the bank that made the loan. And at that point, the bank that made the loan has to have something more than the printing press. It has to come up with real funds to settle with the other banks. And those real funds that it settles with, the stuff banks have to use to pay each other, is bank reserves, which only the Fed can create. They can't create those themselves. So that's where the limit comes in. Now, here's the thing. If a bank wants to make a loan, it sees what appears to be a profitable lending opportunity, which means it thinks that it can fund the loan for less than it can earn on it, right? The bank doesn't have to wait for people to come, for its ordinary retail customers to come and bring it some more money. It can borrow in other ways. Banks do this all the time. They can borrow on wholesale borrowing markets from other banks or from other institutions. So any bank that sees a loan prospect only has to ask itself one question. Can I make this loan and get the funding, if I don't already have some surplus funds on hand, for an interest rate that's going to be low enough to make the loan profitable? If the answer is yes, because they can get the necessary real funds from anywhere, it doesn't matter where, then they'll make the loan. So one thing is true. Banks don't have to wait for savings passively to come to them in order to make loans. But the thing that's not true is that they don't need to borrow from anyone at all in order to make those loans profitably. And that's where these two things are very different. The people thinking that they've shown that banks don't have to rely on savings at all in order to be lenders, because they don't have to wait for savings to come to them, are actually only looking at one possible source of savings. It is the most important. If you look at banks' balance sheets, they rely much more heavily on their retail deposits as a source of funding, at least they have for most of history, than on other sources like other banks or wholesale markets. They do rely on those other sources, but their retail deposits are actually their most stable and reliable and empirically important source of savings.
Okay, great. So folks, don't worry. This is going to be, what I'm about to do is the most technical I'm going to get. I can't, predict what George is going to do in the course of this interview, but this will be the hardest that we'll get, and then we'll make it more just words instead of numbers. But I think what you just said is critical, and let's just walk through to make sure the listeners get what we're saying. And also, too, what we're saying here is not controversial. That's what's weird about this, George. And you kind of alluded to it earlier when you said that the two types of responses you've received on your paper. That didn't surprise me because what I think is going on, just to sort of not keep people in suspense on the edge of their seat, I think there's large-scale agreement between you, me, and the average even MMT theorist who knows banking and how balance sheets work, about the mechanics of, when a bank makes a loan, here's what happens to their assets, here's the liabilities, if there's reserve requirements, this is how they're satisfied, blah, 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 blah. And even when you bring the Fed into it, if we're talking about the U.S., we actually all kind of agree on it. But then when we say, and so therefore, and then we start pontificating about what does that mean, that's when we say three different things, like you, me, and the average MMT person. So it's interesting.
It's just, that's right. And I don't wouldn't finger the MMTs as being particularly egregious in this discussion and debate. There are some aspects of the theory I'm criticizing that they subscribe to, or that are drawn from their body of work. But generally, this is a heterodox view, but not particularly an MMT view that I'm criticizing.
Okay, fair enough.
Yeah.
I guess I've encountered it. It's just because we have our different lived experiences, George, where because I follow a lot of MMT people on Twitter, usually when I see someone making this type of point and citing the Bank of England, it's someone who's a fan of MMT. And that's why but fair enough. I agree. It's not merely MMT people who criticize what they think is the ILF model, let's say. Okay,
and the best of them are much sharper than the worst version of the banks create all the funding they need crowd.
True. Okay, so here's now the technical thing just to go through. So there's Alice owns a hardware store and she wants to get some more inventory and she's running low. And so she goes to her bank, the Acme Bank, and says, I want to borrow $1,000. If they had actual $1,000 in currency in the vault from other customers depositing it, they could, of course, so they would credit her checking account, her business checking account, $1,000. The bank's assets would go up by $1,000 IOU. She would sign a promissory note or something saying, I promise to pay back $1,000 plus 5% interest, 12 months from now for this loan. So the bank's balance sheet's fine. In other words, their liabilities and assets both went up.
Initially. Yes.
And so it's not like the bank's hurting its bottom line by granting a loan. And then, like I say, if they had $1,000 in cash, and then Alice goes and buys some inventory from Bob's nail manufacturer, and then he goes and deposits in his bank of boyhood. And so I'm trying to keep the A's and the B's constant, folks. Right. And so then that bank goes ahead and says to the first Acme Bank, yep, here, we have $1,000 claim on you. And they could just give them the $1,000, and then the $1,000 would just go from the one vault to the other. That'd be fine. And then the dust.
So that's right. Mm-hmm. What's happened in the example you just described is basically you started with a bank that had $1,000 in among its assets. It has $1,000 more in reserves than it needs.
Right.
And so what it's doing is it's trading those reserves for a loan. Initially, its balance sheet goes up because it creates the loans and it still has the reserves. What was her name?
Alice is the borrower.
Alice. When Alice goes and made her purchase and the check or whatever, it gets returned for settlement, then the bank's going to lose as many reserves as the loan it created, and its balance sheet will then be back to the overall size it was at originally, but with the loan taking the place of $1,000 loan taking the place of $1,000 in reserves. So that bank's fine. It's fine. It's perfectly profitable operation. But we assume that it could really fund the loan, beyond just writing it up in the first stage of the process. Mm-hmm. It could also fund it in the more fundamental sense of being able to redeem its claims, the claims it created when it made the loan, when the rival bank asks for them to be redeemed. And that's the funding it needs, is the funding to settle with that other bank.
Right. Okay. So that's fine. I think everyone would agree with that. And now, though, they're going to say, what are you guys talking about? Or they would say, yeah, sure. But even if the first, I think I called it Acme Bank, didn't have an extra reserves in the vault, the currency, suppose they had nothing, they could still go ahead and do that. And then when the Boyhood Bank, I should have come with a better name, a good BB&T Bank, let's say that, that's better. When the BB&T Bank came and said, hey, our customer just deposited $1,000 claim from Alice, we see, it's a claim drawn on you guys. Is she good for it? And they say, yep. Right now, our books show that Alice has $1,000 in her checking account, and we know she has that because we just lent it to her. and we marked it up. That's where it came from. It's from our bookkeeper and his pen or his keyboard. And then the BB&T bank says, okay, so here's our claim on you now, pay up. And at this point, they're in trouble. So the BB&T bank is not going to merely be satisfied with a claim on the Acme Bank. They're going to want actual reserves, either physical Federal Reserve notes, paper currency, or a deposit with the Fed, reserves held at the Fed. So, the Acme Bank, now everyone agrees, so they can just go borrow it in the federal funds market if they have to.
If they have to,
get reserves
they'll do that. Yeah.
And so if the interest rate there is, let's say 4%, and by assumption they thought Alice was good, she would be able to pay back. They thought she was a good credit risk and she could pay it at an interest rate of 5%. That's why Acme is willing to go through the whole thing. Because they're like, we can borrow reserves at 4%, and Alice is good for 5%, paying us back 5%. So we earn that one spread. Once she pays us back, we're good. And that's how it works. And so your critics think, what are you guys talking about? George, didn't we just show you a bank? They created money out of thin air. M2 or M1 went up by $1,000, at least temporarily, depending on what happens. And they didn't have the reserves. They just went out and borrowed it from somebody else. That's what our whole point is. What's your deal, George?
Well, there's several things. First of all, I should say the bank isn't going to fund the loan on the Fed funds market because those are overnight loans. Okay. And if it had to borrow there every night, it would be very expensive. But it can borrow from someone, and it will borrow if it has to, even from the Fed funds market rather than default. But the point is it's having to finance the loan by borrowing. It can't just rely on its own printing or money-creating powers as an alternative from ultimately or originally borrowing funds to cover the loan. The rival bank, the BB&T bank, is certainly not going to just say to the first bank, okay, you don't have to settle with us, we'll cover it. Banks don't do that. They're jealous rivals, and they don't like to be holding on to IOUs from other banks. That exposes them to risk when they can convert them into reserves, Federal Reserve dollars that are safer and more convenient, and they can use to make their own loans and finance their own payments. So the problem, Bob, is that most of these people pushing the thin air theory, as I call it, don't go into the settlement thing. They don't even look beyond the initial. They say the bank writes up the loan, I keep forgetting her name. I'm sorry.
Alice is the original borrower.
Gives Alice.
Sure, it says
gives
A,
Alice,
and then Bob is the other guy. It was supposed to be easy.
Writes up a balance of $1,000 for Alice and is done. Now it has a loan, and it doesn't have to lose any reserves. It could have zero reserves. It doesn't matter. It's got a loan. It's going to earn interest from Alice, and everything is peachy keen. They don't even pursue, in many cases, the consequences of Alice getting the loan. What is she going to do with the loan? What happens if other banks ultimately receive payments initiated by the loan? They don't even look at it. In the Jacob and Cummuth article, the word settlement, right, which is key here, interbank settlement. The word settlement comes up once, and it's not in the context of the banks having to settle with each other. Now, notice, as I've said all along, this is about the difference between the powers of an ordinary commercial bank and those of a central bank. But I could put that a different way. It's about the difference between the powers of a bank that has a lot of competitors, right, in a competitive system, versus the powers of a central bank that has unique privileges of money creation not shared by any other bank in the same economy. And so the reason why Alice's bank can't make the loan can't make the loan profitably, unless it either has excess reserves on hand it wants to dispose of, and the cost of those reserves of disposing of them is whatever the better loan opportunities out there are, or it anticipates being able to go and borrow somewhere at a rate that's going to be less than what the loan is going to pay. And if neither of those things are true, it won't make the loan. It won't make the loan because, as it would, if all it had to do to profitably make a loan was write it up. In my paper, I make an analogy that really, I think, drives this point home. These people are saying that the fact that commercial banks create money means they don't have to borrow in order to lend. I'm not denying that they create money. I am denying that it means what they say it means.
Mm-hmm.
In the same way, you could argue that suppose Jane already has a bank account, but it doesn't have $1,000 in it. In fact, it's drawn down to zero. Jane can create money.
Is Jane the same person as Alice?
I'm sorry. It's Jane. It's Jane in my paper.
Okay.
But suppose it's Alice. Alice has an account already. Forget about the loan, but it's down to zero. She has a checkbook. She can create money. She can fill out a check for $1,000. She doesn't need a loan.
Mm-hmm.
And she has the power of money creation. And maybe the person she wants to buy stuff from, her inventory, will take the check.
Mm-hmm.
Unwittingly, right?
Right.
Takes the check. She's golden. She can create money and get her inventory. Mm-hmm. Well, no, obviously, because the check's going to bounce. And this is going to create problems for her. It's going to create problems for the person who accepted it. But the ultimate point, which nobody would dispute this, is that no, Jane's powers of money creation, as it were, don't really substitute for her having real resources with which to buy that inventory. But it's exactly the same thing for an ordinary commercial bank. Its powers to write up a loan, which is like writing a number on a check, right? Mm-hmm. Except you're giving it to someone else who's promising to pay you interest, doesn't itself fund the loan. The money has to come from somewhere. And if the bank funds a loan or writes up a loan without arranging funding or without having some funding source either on hand or that it can soon go to, when the proceeds of the loan are used, the consequence for the bank is just as if it wrote a bum check with the same implications. And what this theory is trying to do is to deny this. And it's actually really stupid, if you don't mind me saying so. Your audience won't mind, of course. We call people stupid all the time, and we get called stupid all the time, too. But it really is that bad. And, of course, sometimes when you're criticizing something that bad, especially when it comes from a source like the Bank of England, I say comes from the Bank of England, but let's be clear. This was published as a Bank of England working paper, not as an official document of a Bank of England policy or anything. It represents the views of the two authors. Nevertheless, it must sound to many people, as some have told me, that I can't possibly have understood this paper properly, but I think I have. Yeah. And I think it's actually that wrong.
Okay, great. Yeah, a lot there. Just let me highlight two things you said. So, yeah, I think what you said in the beginning of that is perfect to get the average person to see how this works. You said it's the primary difference is between like a modern central bank with, no gold peg and a typical commercial bank is the commercial bank has competitors. And I think the way to underscore that is in our little example here, if Alice, and I believe Bob was the second person's name I made, the guy who owned who made the screws that was selling to Alice, the hardware store.
We have to drag Ted and Carol into the story eventually.
No, Charlie and Daniel. Don't you see it's A, B, C, D? Come on.
Okay. Oh, I'm thinking movies.
If the way our story worked originally was that they banged to different commercial banks, but if Bob was not a member of BB&T Bank, but was another customer banking with Acme, as I think the name I picked, then there wouldn't be an issue with reserve because, like, if they had $1,000 in the vault, they would have taken it out and then put it right back in their own vault. If Bob happened to, and showing they didn't actually need to do anything with the reserves. So if in principle, if there was one commercial bank in which everyone in the whole economy that we're considering was a customer there, then all these reserve requirements would be moot because the bank would just be paying reserves to itself. Would be transferring reserves.
That's right. If you start from a competitive system where my criticisms are applicable, but you then move and you assume there's only one bank, then sure enough, the arguments of the people I'm criticizing in that special case start to look correct. But guess what? That's because having one bank is like having that bank is an awful lot like a central bank. In fact, it practically is a central bank. Central banks, the essential fact about central banks, it's not an incidental thing. It's that they have a monopoly of the economy's ultimate means of payment. Well, if there's one monopoly bank and everybody, as long as everybody trusts it, it's in that situation where it's creating the only money anybody ever needs. So that's unlike the competitive case, which is the one I'm, of course, emphasizing. I understand that we could come up with this special exception. In the competitive case, no ordinary bank can create the stuff it needs to pay off other banks, which we can call the reserve money, base money, final settlement medium of the economy. One bank only can do that, and that's the central bank. It has the power to create the economy's final means of settlement. Another term that's closely related is legal tender, but it doesn't have to be legal tender. Because the Fed creates the final means of payment, it never has to come up with anything it can't create itself. Whereas ordinary banks, in the course of business every day, every afternoon, or sometimes several times a day, they have to come up with stuff they cannot create. And that's the crucial distinction. And in a fiat system, of course, the distinction is all the much greater than in a system. If you have a monopoly bank with a gold standard, even that bank can ultimately find it's got to come up with gold. But when you have a fiat money issuing monopoly bank, a central bank, there's nothing it can ever be asked to pay for ordinary, setting foreign exchange transactions aside for domestic transactions. Nobody can ever ask it to pay something that it cannot actually create out of thin air, as it were.
Right. Okay. I think partly what's going on, because earlier you lamented no one worries about settlement, and that's the linchpin. That's what these people are not getting, is that the individual bank, yes, in the short run, it can just write up whatever it wants, create money out of thin air just by crediting borrowers' accounts with it, but they're not following the train of thought to the next, logical step when the shoe drops. And I think partly what's going on, at least for some of them, like you had this quote from Graeber. So David Graeber, folks, late anthropologist. What was it, like the history of debt 5,000 years of history, something like that? Is a big, famous one.
The first 5,000 years. Yeah.
So he's, a very vociferous critic of conventional economics, with not just about how banks work, but also like how our theory of where money came from, that sort of thing. But anyway, George, in your working paper here, in your page 3, you quote him, and he says, banks can and do create money literally out of nothing simply by making loans, ... Bankers simply wave a magic wand and make the money appear, secure in the confidence that even if they hand a client a credit for $1 million, ultimately the recipient will put it back in the bank again, so that across the system as a whole, credits and debts will cancel out. So George, I think, I haven't gone back and found the original source and looked at it in context, but I think what's going on here is they're just looking at it in the aggregate system, and they say as long as people aren't taking loans and then using it to withdraw currency and then bulking up the amount of $100 and $20 bills in their purses and wallets, if one bank makes a loan, well, someone ultimately is going to deposit it in their bank, and they're just looking at it in terms of the system. Whereas the critical thing that like you and Larry White modeled explicitly was to say, no, the equilibrium conditions facing an individual bank embedded in a system, even if there are no legal reserve requirements, are different. And so it doesn't, from the individual bank point of view, it doesn't matter if the loan it makes is going to get deposited somewhere down the street, because that bank is going to come calling. And the individual bank cares about their individual balance sheet, not, is the banking system as a whole, does it have enough reserves? That no individual bank. So first of all, do you agree that that's partly why Graeber's missing it or missed it when he was still alive?
I think that's right. The system is just as tied down by savings, by its access to savings, as the individual banks are, though. And Larry and I talk about this. In my first book, I talk all about how the total amount of bank lending is constrained by access to savings. That's commercial competitive bank lending. And it's not the case that the banks can rely on each other's loans to, as it were, lift the whole system up by its bootstraps with all the loans nicely canceling out. I talk about this in the paper. There's a theory out there, fairly well established, about banks' precautionary need for reserves. And this is that, banks, of course, can count on the fact that there's a lot of offset on any given day in the settlements. Bank A owes Bank B, but Bank B owes Bank A. To that extent, neither bank has to transfer final payment means or reserves to the other bank, but there are always net settlement dues. There's a randomness to these settlements. And in the end, it turns out that banks as a whole are not able to expand profitably their lending unless there's a corresponding underlying increase either in the reserves that are given to them by the central bank, because when central banks do inject new reserves into the system, then the whole system can expand more. But if that's not happening, the only way they can expand more is if there's more savings. There's an easy, stark way for me to put this point, which is to note the difference between the real savings in the economy and the nominal value or dollar value of savings. Let's suppose banks are all expanding together. The dollar value of savings must go up because people have more dollars whether they want them or not, and that they're either saving, their nominal dollars are equal to their nominal savings of dollars, as it were. But prices are going to go up if they don't want the dollars. Real savings doesn't go up. Well, the size of any nation's banking industry, the real size of the industry depends on real savings. If no one wanted to save any money through their banks, really, that is in purchasing power adjusted terms, their banking industries would die. They would die. There would be no basis for banking. It would be like, suppose a world where people don't want shoes anymore. The shoe industry is going to die. Nothing that any amount of anything no amount of money creation can save the shoe industry if shoes go out of fashion. It's the same way, analogous for any industry, including banking. If no one wants to deal with banks anymore for whatever reason, if you could imagine such a world where nobody wants to put their money in a bank, maybe because they're all holding Bitcoin or something, the banking industry dies. Now, if it were simply a case, as Graeber and others assume, that the banks are propping each other up through their nominal creation of money and it's all a washout no matter how much they create, then the banking industry wouldn't depend on its survival and prosperity would be independent of people's real willingness to put money in banks and to keep a real share of their savings in banks. That's completely counterintuitive. It doesn't make any sense to say that the banking industry as a whole doesn't depend on people wanting to supply real savings to it. It would go against every basic principle of monetary economics, starting with one of the most basic ones, the idea of the long-run neutrality of money. I think your audience is familiar with that in the long run, if you expand the quantity of money, prices go up, but you don't change real values very much. You may change them a little bit here and there because who knows what the adjustments are involved in going from one equilibrium to another. But you generally don't get more employment. You don't make any industry bigger. You don't change dramatically the composition of different industries. And you certainly don't keep industries alive that way. Well, guess what? The banking industry is not immune to the neutrality of money. And yet what Graeber and others are trying to say is, yes, it is. And that of course, they hate economics so much that they'd be willing to reject the whole basic idea of neutrality. But I think most economists would say, no, there's something to that, and we can't just ignore it.
And just to motivate what you're saying there, George, like a silly example, even if the central bank just starts printing up money and, hiring extra janitors or something, and so temporarily, like janitors' wages rise, it would never be the case that in the long run, janitors make more than CEOs. If that were the only intervention, It would just, prices. Yeah, the janitors' wages might rise at the beginning, but they would go spend the money. Then the other prices would start rising. Everybody's paychecks would start rising. And ultimately, if janitors' nominal wages doubled, then CEO wages would roughly double too, so that the ratio would still be what it was before. Something like that.
That's right. And handing reserves to the banking system, even doing that, wouldn't keep the banks alive perpetually if the real demand for their services or for saving through them were to drop down to zero. You'd end up hyperinflating in an attempt to keep them alive, but you couldn't do it. So banks are not unlike other businesses where ultimately the real demand for what they are up to is what's going to determine their scale and size in real terms, in inflation adjusted terms. And in the case of banking, the equivalent to the demand for shoes is the demand for bank deposits and other bank IOUs, the demand to hold on to real quantities of those things.
Okay, great. We got about 10 minutes here. Unfortunately, I have a hard stop, and I know you've got your life in Spain to live. So this segues nicely to what I wanted to wrap up with is, okay, we're talking here about bank operations and this and that, and I agree with you that they're, especially like the kind of work that you and Larry White have done to show the marginal constraints that face an individual bank in a competitive system. A lot of this discussion is totally missing those points. But pulling back, I think there's a huge disconnect in a lot of this literature and these discussions about there should be some connection between like real saving, like households living below their means, consuming less than their income, and that generates a pool of real savings that then gets channeled into certain investments. And, the financial sector presumably plays some role in that allocation. And so to me, it almost seems like a lot of these theorists are completely divorcing the two and acting like they don't have anything to do with each other. And so can you comment on that?
Well, in claiming that banks are intermediaries, of course, I'm saying they do play a very important role. In this particular context, they're acting as the middlemen between savers and lenders, where the saving that they intermediate, of course, isn't all the savings in the economy. It's a subset of the savings, consisting of the savings people want to keep in a relatively liquid form, including bank demand deposits and other types of bank IOUs that they can still use to make payments. So that it's a special kind of savings. If you're somebody who wants to save but still wants to have money, spendable money, why, you can do that by taking your suitcase full of cash from your latest drug deal and, putting KYC and other things aside, putting it in a bank and accepting a bank deposit credit in return. And now that bank is going to be lending. It's going to be lending on your behalf. And you have the privilege or the advantage of being able to still have a money balance. Now, it's important to recognize the minute you draw down that balance, the minute you use that deposit, any part of it, you're saving that much less to the bank. And it should affect, and I say it does affect, that bank's ability to lend. It'll have to lend less as well, ultimately. Its balance sheet will shrink, other things equal. But the banks are playing an important role. And like it or not, when you save through a bank, just like when you invest in a mutual fund, you're letting other people decide the specific kinds of investments that are done with your money. You've handed over that responsibility to them within some limits, sometimes well-defined, sometimes not. But banks are very much part of the savings investment process. And I should say, this is more obviously true for time deposits and CDs where they have a specific maturity. And I think this is often a point of contention within the Austrian school. So I want to emphasize that my own view is that that's a difference of degree, not in kind. When we have demand deposits, we don't tell the bank how long they can expect to have them. The bank has to use its judgment And some banks do this better than others. But if they're wise banks, they're going to not go overboard on the maturity of the lending they engage in, the maturity length of the loans they make, given that they're borrowing from people essentially overnight, right? We can take our money back at any time. So it becomes a different kind of managerial challenge for a bank to intermediate demand deposits as opposed to CDs, a more difficult challenge. But it's still intermediation because there's still savings involved to the extent that people hold these deposits. But it's, as it were, it's conditional savings. It's savings that lasts until it doesn't. And at that point, a well-functioning banking system is going to respond by lending less.
Okay. So yeah, folks, obviously with the time constraints here, so as George alluded to, and he and I have literally debated on this particular topic at the Soho Forum. I won't spoil it by saying who the audience think won the debate. Then you folks can figure out why I don't want to say. And I'll link, of course, everybody to those if you want to follow that. But let me just say the point once more, George, and I'll give you the final word here. So yes, despite the fact that George and I have some differences, and it has to do with Austrian business cycle theory about certain elements of commercial bank behavior and whether it causes the business cycle or not. But my broader point here is, it seems like the thin air theorists, at least some of them, the crudest ones, let's put it that way, they're saying, oh yeah, banks can go ahead and make loans to business people who can then go and invest and blah, blah, blah. And that has absolutely nothing to do with household saving behavior. And so my point is, they're saying that like it's fine. And I was like, well, doesn't that alarm you? Like, shouldn't the ability of businesses to make investments and to go buy factories, shouldn't that have some at least tepid connection to how much households are living below their means? Because otherwise, but then on the other hand, was at least some of, that's why I'm tying it to MMT. Yeah, some of them are more careful and guarded in their statements. Other ones, it's almost like they don't think scarcity exists, or it only does when you remind them of it. They're like, oh, yeah, sure.
Well, it's interesting, Bob, that you bring this up, because I've seen some of them allude to Schumpeter's work on the theory of economic development. And this is another case like the Bank of England working paper case, where they have a good economist they can drag in, Woody Allen-like, and say, here's somebody who's famous, or at least from a reputable source, who's saying what we say. Because Schumpeter's point was, you won't have any economic development unless you have some money creation-based lending that isn't also supported by savings. You have to have some forced savings. I talk about in my paper. But that's where when you make loans and there's no real savings initially to back them up, you get forced savings, which is a transfer, as it were, confiscatory transfer of wealth that is arranged through these loans that comes as a result of inflation, right? With people holding money or have an inflation tax imposed on them. And that's what's really financing the lending. Schumpeter said, you need that. Otherwise, you're just going to be stuck in a stationary state economy that can never grow. That his theory is all wrong. We don't have time.
I know. I guess we got to cancel Schumpeter now.
Yeah. But even great economists make mistakes. And Schumpeter, and in this case, made a big one, in my opinion. So the point is, you will always find heterodox thinkers, whenever they have a bad idea, they'll scrounge around to find an economist who had a bad day and said that something in its favor. And then they'll make hay with it. But just because some folks at the Bank of England made hay with the view that banks aren't intermediaries is not a good enough reason for people to buy into that, as many seem to have done. In the same way that just because Schumpeter said you need a little forced savings now and then if your economy is going to grow, doesn't mean that that's true and that people should buy into it. Every economist make mistakes. This one that I've been dealing with, by the way, and my paper makes clear, I'm not the first one to point out that it's all wrong. Several economists have tried to do so because it keeps coming back every few decades, this dumb idea. The one I look upon with the most fondness here is James Tobin, who absolutely smashed this idea to smithereens in 1963. He's cited by Kumhoff and Jacob and Kumhoff, but in a way that doesn't give any clue to the readers of just how devastating his critique of the idea they were now promoting again really was. I urge anyone interested in pursuing this, don't just read my paper, but please read it. Go ahead and read James Tobin's too, as he was a better economist than me, and he made the very similar points with different targets, of course.
Okay, well, unfortunately, we have to end there. So, folks, as George says, if you're intrigued by this discussion, and we'll at the links on the show notes page for this episode, I'll put George's paper, some stuff I've written, the debate he and I had at the Soho Forum, and then, of course, the Jakov and Kumov article as well, just to make sure you're getting a fair and balanced take. So my guest this week has been George Selgin. George, thanks so much for your time.
You're very welcome, Bob. It's been fun.
Thank you, everyone, for tuning in. And we're glad there's a group out there who's interested in these difficult but important ideas. We'll see you next time.
This concludes another episode of InFi, The Future of Finance, with Dr. Robert Murphy. The information provided is for educational purposes and does not constitute financial advice. Consult with qualified professionals before making any financial or investment decisions. For more information on the host and for previous episodes, visit InFi, thefutureoffinance.io. Thanks for listening.